Hello student, I Ankita Bawane, an assistant professor in Tulsiramji Gaikwad Patil, College of Engineering and Technology, Nagpur, conducting the presentation for MBA second semester for the academic year 22-23. Welcome back to the another presentation on long-term investment decision, capital budgeting, where we will explore the intricacies of making decisions that have a lasting impact on organization. By the end of this presentation, you will have a clear understanding of how to navigate the complex landscape of business decision that can make up the future of your organization. Now, I know what you might be thinking investment that sound complicated, but fear not, we are here to break it down into simplicity. So, without further ado, let's get started. These are the main content of our today's presentation. We will start by introducing our today's topic, that is capital budgeting. Next, we will discuss the objective and features of capital budgeting. Next, the types of capital budgeting, and I'll provide the conclusion of our today's presentation. Long-term decision is a very crucial decision to be taken by the management as to the selection of the best investment proposal out of the available option. And such decisions are taken after examining the pros and cons of each proposal in details, quantum of capital outlay, estimated future return likely to accrue, etc. The entire process of investment decisions is also known as a capital budgeting or a capital expenditure decision. In any proposal under a consideration of capital budgeting, the capital outlay is generally instant, whereas the benefit generally start pouring in after a long gap of time, generally after a 1 year. So now let us see the capital budgeting in detail. Investment decision pertaining to long-term asset for the purpose of generating revenue for the business entity and not for the sales such as the land, building, machinery, furniture, etc. is termed as capital budgeting. It involves long-term planning and monitoring of capital expenditure. So beside examining each proposal is a very logical and scientific manner so as to finalize the best proposal. Capital expenditure differ from the revenue expenditure in the sense that the benefit from such expenditure are necessarily generated after a long gestation period which is generally beyond 1 year. So in the case of revenue expenditure, on the other hand, the benefit are generated and exhausted within the year. Charles Horngren, who was an American accounting scholar and professor of accounting at Stanford University, said that capital budgeting is a long term planning for making and financing proposed capital outlays. Next, we have the objective of our today's presentation. The first objective of our today's presentation is to provide a clear and comprehensive explanation of what capital budgeting is. And second is to discuss various capital budgeting types. Next we have the features of capital budgeting. So these are the main features of capital budgeting which are going to be discussed by one. So the first one is long-term investment proposal. The long-term investment proposal are subject to capital budgeting technique. Next we have decision on single project or for two or more project proposal. The business may take an investment decision on a single project proposal or for two or more project proposal which are mutually exclusive simultaneously. And the last, maximization of value of business. So maximization of value of the business organization should be the sole criteria for selecting or dropping an investment proposal. Next we have the types of capital budgeting. First of all, we discuss about the expansion and diversification. So, the expansion at a certain phase, a company engaged in a manufacturing activity may feel the need to enhance its capacity for manufacturing the same product. To meet the increased market demand, if it may therefore decide to invest in plant and machinery with an objective of increasing the production of its product. To illustrate this, an example of urea manufacturing unit may be taken. So, if the capacity of that unit is X metric ton per annum and it sees and increase in the demand for urea in the market, so it may decide to invest in acquisition of the additional plant and machinery to increase the production of urea to the level of X plus in order to meet the market demand. Sometime a company acquire another company to expand its business. Next, diversification. A company engaged in a particular line of business may decide to diversify its activities in an altogether new line of business because of the better business opportunities in that field. So, venturing into a new field necessitates investment in new techniques, manpower, etc., beside new plant, machinery, and related equipment. For example, Housing Development Finance Corporation, that is SDFC, engaged in a business of housing finance and decided to enter into the business of banking in 1993 when the sector was opened by RBI as it saw greater opportunity therein. So SDFC Bank came into existence and today they are the leader amongst the private sector bank. A company decide to invest in order to diversify in a different field with the expectation of the additional revenue. Next, replacement and modernization. A company may consider investing in modernization and replacement of obsolete assets with a view to keep pace with the advent of new technology for improving operational efficiency and minimization of cost, which result in a higher level of profit. Such investments require substantial capital investment with no immediate return, but in the long run, the company is a beneficiary. For example, huge investment is required in paper producing company to change its manual handling machine to the fully automatic producing equipment. However, after some time, the company start reaping the benefit in the form of increased efficiency and increase in its revenue. So, investment for acquiring more efficient asset with the features of advanced technology is also called reduction investment. Next, mutually exclusive investment. If there are many choices for making investment for the similar objective, there will be a sort of competition amongst them and only one of them will be selected at a time and other will be logically rejected. So this concept will be clear from an example. If a company has a two investment proposal to buy machinery for production, the first proposal is to buy a semi automatic machine which is a labor intensive, and the other one is to buy a fully automatic machine which is a capital intensive. After applying the technique of capital budgeting, the company may decide in favor of one of this proposal and other one will be automatically rejected. So there is an element of competition among such a proposal. Next, independent investments. As the nomenclature suggests, there are two independent investment proposals having a different objective in contrast to mutually exclusive investment. There is no element of competition among such a proposal. For example, two independent proposals may be under consideration of the automobile company. One proposal may relate to expansion of its plant capacity to manufacture family and office purpose car, and the other one may relate to the addition of new production facilities to manufacture mobile set, a new product. The company may decide in favor of both the proposal or both the proposal may be turned down depending upon the outcome of the capital budgeting. Next, contingent investment. So investment in one project compel the business to spend additional fund related to that investment. So the investment made an dependent project are known as contingent investment. For example, the company to start a medical college may be contingent upon a decision to establish a hostel for the student in the premises of the college. Next, research and development project. Most of the Indian companies conveniently believe that the investing in research and development project is a waste of money. If all that they decide to make investment in R&D in form of very small percentage of total capital budget. Of late, the trend has started to change as the companies have realized the significance of R&D in modern business, especially those who are in a knowledge intensive industry. Allocation of fund for R&D project has shown an increasing trend during the last few years. Evaluation of R&D project is a complex process and involve a lot of decision making. So discounted cash flow analysis is not applicable to such project. Decision to invest in this project depend upon the opinion of the top management. Mostly to access the project, companies depend on quantitative tool like a decision tree analysis and option analysis. And the last part is the conclusion. The first conclusion is capital budgeting principle empower businesses to make informed choices that align with their goal and financial health. And the second, we explore various type of capital budgeting. By delving into this concept, we have laid the foundation for effective investment evaluation and decision making. Thank you so much for watching. If you found this video valuable, don't forget to give it a thumbs up and hit that subscribe button below. If you have any question and or want to share your thought on today's topic, please leave a comment down below. We will see you in the next video. Until, stay inspired and keep learning. Bye for now.